If you or a loved one is living with diabetes, whether type 1 or insulin-dependent type 2, managing your condition requires constant daily care, specialized equipment, and significant out-of-pocket expenses. Fortunately, the Canada Revenue Agency offers substantial tax relief through the Disability Tax Credit, or DTC. Recent legislative changes have drastically simplified how individuals with type 1 diabetes qualify. Today, we're breaking down the official CRA rules for both type 1 and type 2 diabetes, how to claim up to $2,400 per year in combined tax savings, and how to access up to 10 years of retroactive back pay. Let's start with the most critical update for type 1 diabetes. Following legislative changes to the Income Tax Act, all Canadians diagnosed with type 1 diabetes automatically meet the CRA criteria for life-sustaining therapy for tax years 2021 and onwards. In the past, type 1 applicants had to prove they spent at least 14 hours every single week on therapy-related activities. For 2021 and future years, that 14-hour tracking requirement is completely eliminated for type 1 diabetes. Your doctor simply needs to verify your diagnosis on Form T2201. Now, what if you have type 2 diabetes, or you are applying for retroactive type 1 back pay for years prior to 2021? In these cases, the CRA's 14-hour life-sustaining therapy rule still applies. To qualify under this pathway, you must demonstrate that administering insulin and managing dosage takes an average of at least 14 hours per week. Eligible activities include checking blood glucose levels and logging trends, calculating and adjusting insulin doses, administering injections, or maintaining continuous glucose monitors and insulin pumps. Note that exercise, dietary planning, and routine medical appointments do not count toward the 14-hour requirement. If you have type 2 diabetes and do not take insulin, you can still qualify if diabetes has caused severe secondary complications. The CRA evaluates functional limitations in categories such as walking, severe peripheral neuropathy, diabetic foot ulcers, or amputations that make walking take 3 times longer. Vision, significant irreversible vision loss caused by diabetic retinopathy. Cumulative effect, combining moderate limitations, such as moderate vision loss plus moderate walking difficulty, where the overall impact equals a 90% marked restriction. To submit a valid claim, your medical doctor or nurse practitioner must complete Part B of Form T2201. For Type 1 claims filed for 2021 onward, your physician skips the detailed time logs and checks the designated T1D box. However, for pre-2021 claims or Type 2 applications, your doctor must accurately attest to the 14-hour weekly requirement or detail your specific daily physical restrictions. Once Form T2201 is certified, you can submit it digitally through your CRA My account or by mail. If approved, the CRA can adjust your past tax returns up to 10 years back to the date of diagnosis or therapy onset. If the applicant has low taxable income, such as a senior or student, the unused tax credit can be transferred to a spouse, parent, or supporting family member to reduce their tax owing. Managing diabetes is a lifelong financial and physical commitment, but the disability tax credit is designed to offset those costs. For our full written diabetes guide, eligibility calculators, and free assessments, visit the links in the description below. Don't forget to like, subscribe, and drop your questions in the comments. Thank you for watching, and we'll see you in the next guide.